Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Greenbrier Companies, Inc. quarterly report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The Greenbrier Companies, Inc. offers a diverse range of businesses and services to the railroad industry. At its core, the company designs, manufactures, and markets railroad freight car equipment for clients across North America, Europe, and South America. In terms of manufacturing, the Greenbrier Companies produces a wide variety of railcars, including covered hopper cars, gondolas, tank cars, intermodal railcars, and more. They also offer reconditioning services for wheels and axles, as well as new axle machining and finishing. Additionally, the company operates a railcar maintenance network to ensure that its clients' equipment is in top condition. The leasing and management services segment of the Greenbrier Companies provides operating leases and per diem leases for over 17,000 railcars. This includes management services such as railcar maintenance management, accounting, fleet management, logistics, administration, and remarketing. The company's clients include railroads, leasing companies, financial institutions, shippers, carriers, and transportation companies. Overall, the Greenbrier Companies offers a comprehensive suite of products and services to the railroad industry, from manufacturing and maintenance to leasing and management. The Greenbrier Companies, Inc. GBX stock price has dropped by 12.72% in the past year due to several factors. One major contributor was the sell rating given by Goldman Sachs, which cited negative industry cyclicality and a decline in revenue of 8.59%. Additionally, the company's own performance was marred by declining revenue and net earnings, with a 19.4% decrease in total revenue and a 26.8% drop in railcar deliveries. Analysts also projected a challenging year ahead for Greenbrier, with estimated earnings decreasing by 37%, which contributed to a lower price-to-earnings ratio compared to the broader market. Furthermore, consensus earnings per share estimates fell by 17%, and analysts reduced their price target for Greenbrier's stock by 8.4%. The cyclical downturn in the heavy transportation equipment industry also had an impact, with Greenbrier's annual revenue declining by 12.2% over the last 2 years. The company's European operations were also negatively affected by operational inefficiencies and restructuring efforts. While Greenbrier did report some positive news, such as beating EPS and revenue estimates for Cone 2026 and strong performance in its leasing segment, the overall trend of declining manufacturing, lower year-over-year revenue, negative analyst sentiment, and industry-wide headwinds likely contributed to a significant stock price drop over the past year. The primary drivers of revenue growth or decline can be identified through a review of the company's financial performance. In terms of decline, the manufacturing segment was a significant contributor, with revenue decreasing by 41.6%. This decline was driven in part by increased depreciation and amortization costs, as well as reduced capital expenditures. In contrast, the leasing and fleet management segment experienced growth, with revenue increasing by 9.1%. This growth can be attributed to recurring revenue from this segment, which contributed positively to overall performance. Additionally, specific drivers of decline include a decrease in deliveries, an unfavorable change in railcar manufacturing product mix, and reduced revenue from railcar sales. On the other hand, specific drivers of growth include increased rents associated with the expansion of the lease fleet, as well as improved lease rates that contributed to revenue growth. These factors highlight the importance of diversifying revenue streams and adapting to changing market conditions in order to drive long-term success. The net income and profit margins of the company underwent significant changes over time. Initially, the net income decreased from $59.1 million to $37.3 million, representing a decline of $21.8 million. This downward trend was also reflected in the profit margins, which dropped from 51.5% to 38.6%. The decrease in profit margins can be attributed to various factors. One major reason for this change is the shift in working capital management. The company experienced a decrease in accounts receivable, net, by $65.3 million, while simultaneously increasing its accounts payable and accrued liabilities by $76.2 million. This imbalance had a negative impact on the company's cash flow and ultimately affected its profitability. Additionally, the company incurred a significant loss of $17.7 million due to the disposition of equipment. Furthermore, the European operations experienced a decline in earnings, resulting in lower non-controlling interest. These factors collectively contributed to the decrease in net income and profit margins. The company is experiencing a significant improvement in its operating cash flow. In 2024, the company reported a net loss of $65.1 million in operating activities. However, in 2025, this figure has reversed to a positive $76.2 million. This substantial increase indicates that the company's operations are now generating sufficient cash to cover its expenses and investments. The shift from a negative to a positive operating cash flow is a significant milestone for the company, suggesting improved financial health and stability. The performance of various segments and regions has been analyzed based on the extracted summaries. In terms of underperformance, two key areas stand out. Manufacturing was a notable disappointment, with revenue plummeting from $121.6 million in 2024 to just $48.6 million in 2025. This significant decline indicates a substantial drop in production or sales within this sector. Leasing and fleet management also struggled despite showing an increase in revenue from $21.9 million in 2024 to $44 million in 2025. Despite the growth, it is still classified as poor, suggesting that the industry's overall performance remains subpar. Management is expressing optimism about the company's future performance despite acknowledging potential risks and uncertainties. The company has a multi-year strategy in place to increase recurring revenue, expand gross margin, and boost return on invested capital. Despite ongoing macroeconomic uncertainty, management believes it is well-positioned to execute this strategy successfully. Additionally, they expect existing funds and cash generated from operations to be sufficient to cover debt repayments, working capital needs, planned capital expenditures, and dividends over the next 12 months. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which have been consistently paid out over the past 2 years. In 2024, the company paid out $10.4 million in dividends, while in 2025, it paid out $1.7 million. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. In 2025, the company invested a significant amount of money in buying back shares, totaling $12.9 million. This move is likely aimed at increasing shareholder value and reducing the number of outstanding shares on the market. Concerns about inventory buildup and supply chain disruption have been raised due to several indicators. The increase in finished goods from $97.7 million to $136.6 million on page 14 suggests a potential buildup of inventory. However, the decrease in inventories on page 11 is not clear-cut, as it may be influenced by other factors. The risk of supply chain disruption is also evident. A sustained economic slowdown or continued supply chain disruption could significantly impact operations and financial performance, page 30. Furthermore, changing trade policies, tariffs, and geopolitical uncertainty are mentioned as potential risks that could exacerbate the situation. These concerns highlight the need for careful management to mitigate the effects of inventory buildup and supply chain disruptions. That concludes the financial summary for the Greenbrier Companies, Inc. Feel free to comment below, and I will be happy to answer them when possible.